Good morning, everybody. This is Dan Sheridan, and I'm going to look at a 24-day calendar here in SPX. This is the week of July. Today's Tuesday, July 9th. Quite a bit of news this week. CPI tomorrow, PPI on or Thursday. What is it? Thursday and Friday. Different events this week. So what I'm looking at this week is, as far as range bound trade, we haven't been range bound. When you look at the last week, we were up about 100 points, and that's more than you normally would move in 7 days. So we're not really range bound. You have a lot of news this week. So when that happens, I'm trying to go out a little more duration because the market's just been one way up. Maybe put a calendar a little bit under the market. But the key is, what I'm trying to do is, when the market's not as range bound as I want, a little more turbulent, when there's quite a bit of news, I try to get the gamma maybe minus 0.03 or lower. What does that mean in English? It just means if we have a 1% move up or down in the SPX, which is almost 60 points, your deltas don't move that much against you, right? And that's good, right? That means you're able to weather it a little better, right? It's like being in a bigger airplane versus a puddle jumper when you go through turbulence. So here's an example of one, a calendar, August 7 to 24-day calendar. So something I would put on a Tuesday. So the expiration would be 3 weeks from this Friday. And then there's 5 days between the long and the short. And I'm placing it, if this is where we are in SPX, I'm placing it 10 points, 10 to 20 points underneath where we're trading at. So that gives me a little bit head start to the downside, anywhere 10 to 20 points under. And my deltas are still neutral. So I'm getting a little bit of head start to the downside, but I'm not committing the delta. So this is going for around $6 if there's 5 days between the long and the short. So that would be basically $6, and that's my risk. And that's what I'm looking at putting on today. Again, a 24-day call calendar in SPX, 5-point difference between the long and the short. And I have positive theta. We're positive theta traders. Long Vega, VIX is in the lower end of the range. So this is something that you could put on a regular basis every Tuesday. It gives you good protection if the market moves against you. It has positive theta. And again, you could, to get in a habit of doing it, you can put it on Tuesdays, 3 weeks from this coming Friday, right? So that would be August 2nd, 5 days between the long and the short. As you get more experience, if you want to commit more capital, you could put 7 days between the long and the short, or 14 days. So that's it. And if you want I'm Dan at Sheridan Risk Management.com. And if you'd like to check us out and see, we have a couple hours of live teaching a day. It's all recorded, where we're going over trades like this, live trades. We're going over the risk management, how to do it. If you want to develop into a better craftsman, this would be a great way to do that, as we work through trades and concepts and teach you how to do this yourself. And if you email me, Dan at SheridanRiskManagement.com, I could give you for $97 for a month to access to everything we have, which is our couple hours a day at 9:50 Eastern and 2 Eastern. Our teaching classes, there's other stuff sprinkled in, and all our on-demand videos as well. So, and we'll be discussing this today as far as the risk management, adjusting, this type of stuff that we talk about daily. So just send me an email, Dan at SheridanRiskManagement.com. And if you just put in the email, hey, Dan, I'd like to take you up on your $97 offer for a month for everything. I'd be happy to get you going on your way to becoming a better craftsman. And thanks for everything. We'll talk to you next time. Thanks.